GM, good morning. Welcome to the Milk Road Show, the daily crypto show where our updates are as rare as finding a Netflix show everyone agrees on. I'm your host, Jay Hamilton, and today we are joined by Tyler Neville, head of marketing and macro analyst for Corriente Advisors. Now, in today's episode, we're talking about debt, not your debt, government debt, sovereign debt. We'll discuss how do you protect your money in a world where prices are constantly rising, currencies are losing value, and the financial future is uncertain. And all of this debt that we're creating, is this a bubble that is going to pop at some point? And why is that leading people towards Bitcoin and gold and other forms of reserve assets? Before we jump in, are you subscribed to us on YouTube? If you're not, you're going to want to subscribe today because we're giving away free stuff. If you subscribe before we hit 10,000 subscribers, you could win our crypto investing masterclass valued at $500. It'll give you everything you need to create a portfolio of your dreams. Tyler, welcome to the Milk Roadshow.
Thanks for having me. What an intro. I loved it.
Oh, thank you. I appreciate it. Very excited to have you. Tyler, before we jump into the current macro environment and talking about debt and where all this could be headed and how this could end, can you just give us a little bit of background on Corriente Advisors and how your firm was created? It sort of will help, I think, our listeners understand the way you and your fund look at markets.
Yeah, Corriente Advisors is a macro hedge fund. Basically, it was started by a guy named Mark Hart, who was most famous for shorting the subprime crisis in 2008. But Mark's whole framework is essentially going around the world, finding the biggest imbalances in the world and making bets on, asymmetric outcomes. So, the subprime crisis was one. Then in 2010, he bought credit default swaps on European sovereign debt before that went to shit, excuse my French. And, he was one of the first investors, macro hedge fund investors in Bitcoin in like 2014, 2015. Has kind of been on the front ends of a lot of like big macro thematic, I call them the tectonic plates of the market. Mm-hmm. So that's where it started. But we find big supply and demand imbalances and try to make the best bet asymmetrically that will get a outsized return.
Fantastic. So it would be fair to say that you and your partners in your firm very much view the market from a macro, more long-term perspective, more understanding the bigger moves that are going to lead us, decades from now. So with that perspective, how would you explain the current macro environment that we're in?
Well, just from a risk perspective, what a lot of funds have done, they've really systematized the market, and a lot of these risk-adjusted returns and low volatility over time create these giant imbalances. And so the strategy of actually investing in frontiers and growth has largely been neglected for the past 15, 20 years. So we're on, we're of the view that eventually, it's like death by 1,000 cuts. When you have risk-adjusted returns over risk-adjusted returns, you end up cannibalizing your own returns over time. And then these opportunities like Bitcoin per se, which has absolutely crushed any other asset for the past 15 years, people ignore them because they're mandated to have these like low return strategies. So there's a lot of different ones out there, but Bitcoin is one specifically we concentrate on.
Mm-hmm. So if we take 2008 as a real turning point in monetary policy and in the way that debt is distributed, can you sort of explain how sovereign debt changed post 2008 in developed markets?
Yeah. So basically what happened was households were massively in debt, corporates were massively in debt, and through QE, the governments came in and took all of those, debts off the balance sheet of the corporates and households. And that's pretty much been the entire function of the market for the past 15 years. Is in one way or another, they come up with a new acronym and they bail out certain parts of the market. And it's countless the amount of times it happens. It happens in the money markets, it happens in high yield, it happens in mortgage-backed securities. And what it really is just a massive dilution of your fiat currency whether it's by monetary policy by the Fed or by fiscal infrastructure plans. And, that's largely the case. Now, all that money that was on the corporate balance sheet and household balance sheet is now transferred to the government balance sheet. So if from 2008, if you look at the total Fed balance sheet, it's just up and to the right, parabolic. So they've taken on that risk because they can print money and, essentially dilute your currency. And so everybody in the world is calling, they think it's 2008 again. They're calling for credit crises. But the truth is that they can't let their governments go bankrupt. They functionally can't. So they keep, diluting it. And we're at the point now where I call it nominal GDP targeting. A lot of people call it nominal GDP targeting, but you essentially have to issue debt to stew growth. And it's basically like a big con game where you shouldn't really buy bonds when the government has a 7% deficit, but we do because we're the world's reserve currency. So, but it's a slow dilution and it forces you out into different parts of the market. So that's sort of the backdrop of where we are on the sovereign end right now.
Okay. And so 2 questions. How do governments manage this debt crisis then? What strategies do they take? And maybe let's talk a little bit about nominal GDP targeting, because I think that's an important concept to understand for where this conversation is going.
Nominal GDP targeting is essentially like you have these giant debts on government balance sheets now. And to service those debts at interest rates, you need to stew growth. So you basically push money out into the economy by one of 2 ways, maybe both ways. One is monetary policy, which is lowering interest rates. And the other one is fiscal. So you get together, Congress gets together and decides on a giant infrastructure plan or the CHIPS Act or any of these, the Inflation Reduction Act. And that money goes into the market. And then there's a multiplier effect. So once that goes in the market, there's more buying and selling, and GDP essentially rises because of it. And so that growth should theoretically satiate the interest rate expense on the sovereign debt. That's sort of the market we've been in. And everyone's calling for a blow up, but the thing they're missing is sovereigns have the ability to print money and a lot of different levers to pull where corporates don't. And so the backdrop is bad because when it gets to the sovereign balance sheet, you basically make the decision to annihilate the middle class. It's the most simplified way of saying it because you're pushing money into the higher echelon of society, and it's supposed to be a trickle-down effect. But the inflation inevitably kind of gets the middle and lower classes. That's where they get hit the hardest.
So I think the question is, the next question is like, how does this all end? And I know you don't have a crystal ball and you can't predict it, but let's just talk about what are the impacts of this level of sovereign debt on our currency? How does this sovereign debt dilute our currency? What does it look like for us regular people?
Yeah, you see the market at all-time highs. Everyone, sentiment is horrible on the ground, but the market keeps rising. And you try to find assets that kind of protect your purchasing power in that dilution. It's hidden. In a simple, we use this simple way of thinking about a basket of goods. So if you have a basket of goods that is $100 and you have this giant fiscal infrastructure plan that pushes inflation up to say 4% per year, that basket of goods at the end of the year is $104. But what's interesting is that we also have this kind of productivity boom going on because of AI and software and other types of productive things. So the opposite side of that is productivity. If you have $100 basket of goods and you have 4% productivity, meaning that $100 basket of goods is now $96 at the end of the year. So that difference between the inflation 4% and the productivity 4%, you have an 8% difference. And in that difference, if you're holding cash, you're getting eaten up by an 8% tax on either side. So 4% on inflation, 4% on productivity, which basically forces you to invest in the market or forces you to invest in something. And this is why Bitcoin is really, really interesting because it's the only thing there's less and less supply of. And you clearly see it relative to, Fed balance sheet and
Mhm.
a lot of other assets. There's other ways to protect from the productivity gains, which is you have to invest in productive assets. AI is very productivity enhancing. So if you own a company that really helps small businesses be more productive, that's one way of doing it, which, it's largely why we see stocks rising. Corporate profits
Mhm.
are at, wides because of the productivity, and the inflation's been coming down. But so that little mathematical example is
Mhm.
kind of what you have to keep in mind in a giant fiscal backdrop where they're pushing money into the market
Mhm.
via the fiscal mechanism of
Mhm.
infrastructure plans and whatnot. And then on the monetary side, as they lower rates, that inflation number can go up a little bit higher as well,
Mhm.
because it allows you to borrow more money. And every time you borrow money to spend in the economy, that's someone else's money to borrow and spend. So it's that
Mhm.
reflexive nature. So this is why, the backdrop, it's hard to have, it's crazy to say, but it's hard to have a recession in that backdrop unless
Mhm.
there's a credit problem in the market somewhere, unless you lent to a sector of the market that the growth doesn't keep up. So housing was 2008, right?
Mhm. Mhm.
Oil was like 2015. They over levered the oil companies. And so now, it's just largely pushed into all these different other parts of the market. And it seems to be, if you look at credit spreads, the growth is enough where they are paying off the debt. So
Mhm.
that's sort of where we're at. But, the best risk reward for us is something that has a finite supply. And as you keep diluting the currency, and this is globally, by the way, this is not
Mhm.
just that. This is happening in all developed markets. And so Bitcoin becomes super interesting there because the supply keeps shrinking, and then it has this convex payout at the end when, was it 2020, 2120, when there's no
Mhm.
more Bitcoin left, and you have just dilution of all sorts of currencies to pay these massive debts. Things get really funky.
Mhm. I love that you said the year 2120 because that's a long way away. Just while we're talking about this we've been in this current situation of quantitative easing basically since 2008. We've been in these 4-year cycles. How long do you think that continues for?
uh, Forever. I mean,
Really?
demographically, we're basically in a wartime finance, and this is the norm in history. What's so
Mhm.
funny to me is, everyone is peeking over their shoulder for a credit crisis on the sovereign
Mhm.
balance sheets, which could happen if there's a geopolitical event or war or something
Right.
like that, and inflation gets out of control. But, you know, right now it's really hard to predict that. What was
Yeah.
the original question? Sorry about that.
No, no, no. I think you're. My question was how long can this continue for? Can it go for 100 years? Because last time we had this happen was basically post World War II,
Mhm.
and I believe it went for about 20, 22 years before the boomers basically provided us with the productivity lift to pull us out of the monetary cycle and more into regular business cycles. So, and am I correct in saying that we have been in this before and we've gotten out of it?
Yeah. I think, they printed enough money, paid off the debts, and,
Mhm.
had some productivity gains, et cetera. And maybe that's what AI and the promise of a lot of these, if this
Right.
is the 21st century technological revolution, it's possible to grow out of it. But either way, I think the governments have no other choice at this point. The demographics are rolling over. You have all these giant entitlements like Medicare, Social Security.
Mhm.
You're not
Mhm.
going to take those away.
No.
It's just, it's a matter of fact. And not only that, but then, if you look out 10 years and the politicians change and our generation gets in office, student loans and all these other outrageous debts will
Right.
probably be papered over, or there'll be some sort of, tax. They'll
Mhm.
figure out an acronym to forgive all that stuff. It's just the nature of how these generations play out. So I think they'll keep doing it. And in the end of the day, like, look at the Weimar Republic. They printed money. Had wheelbarrows of cash when, the goods were going up 100% per day. So that's
Wait,
just,
who is this? The Weimar Republic?
yeah, back in World War II, Germany essentially had all these
Okay.
war debts from World War One, and couldn't pay them, so they just diluted their currency. There's a great book called Lords of Finance, The Bankers Who Broke the World by Liaquat
Mm.
Ahmed. And he talks, this is the norm throughout history, is you always go from public to private money. And governments, inevitably choose inflation as the way out because it's too hard to actually tighten your belt and kind of like strap in and do austerity. So I think that's just the end result. And what's going to happen is that gap between productivity and inflation grows and grows. And then you need stores of value. It's why gold's working. It's why Bitcoin's working. It's why tech stocks are working. It's the only thing that keeps the growth rates above the inflation number right now.
So just to go back to, you mentioned recession, and that's a word that gets brought up pretty much every day on this show. And there's a lot of fear in a lot of people saying, hey, we are going to have a recession. It's inevitable. It's coming. And then there's also this other side of people who say it's not possible to have a recession because of all of these monetary policies and this printing that's happened. And what's your view on it?
I think you can definitely have a recession. What's my view on it is, if oil stays, if there's pumping enough oil to keep the inflation at bay, then you won't have recession, because if you keep having these giant infrastructure plans. The thing that breaks everything is when oil spikes and credit spreads basically widen, and when oil spikes, treasury yields generally rise, and that causes the financing costs rise, the cost of capital rises. So if you can keep inflation down, which we have, like, what's interesting is the US is pumping more oil than we ever have before. And you could honestly make the argument that there's enough oil reserves in Antarctica to satiate global oil demand for like the next 15 years or something. So they'll find more oil. I think it's just a matter of like, is there a conflict that destabilizes it in the Middle East? That would lead to some sort of recession, because then the financing costs rise and you have some credit rumblings. But other than that, like, it's kind of nuts to think about, but you can keep printing. In fact, if you lower rates, you might even be able to pump more oil, because the financing costs to pump oil drop, and then the debt markets provide that. And you have this other benefit, because baby boomers are getting older and they're risk averse, so they put their money in bonds. And that allows financing costs. It's this structural mandate for older people to invest in bonds, even though they're really certificates of confiscation. Like, it's the dumbest bet ever. Like, what? And not only that, but like the next 20 years, what person who's a millennial or Gen Zer is investing in a bond? It is mind-boggling. Like, that's why, to me, everyone's like, oh, the stock market, it can't go up anymore. It's going to crash. It's like the risk reward for buying a bond is like negligible. So one of my big problems is these guys who are just like, they're 50-year-old, market gurus, and they're like, these young kids, it's all about financial nihilism these days. But they take that in like a 10 to 15 year span, is like, they're investing in Bitcoin and altcoins. It's so bad. But like, that's been the norm throughout history, is once the governments get corrupt, you always go to the frontiers. It's why, people left England and came to America to go, settle the frontier markets. That's you are forced to, and there's first movers, and like, that's just the nature of how human nature is. And then the incumbents that kind of choke the growth and put up guardrails and bureaucratic systems so that they take all the growth themselves, they end up forcing people out into the frontiers. And they call it nihilism, but it's really just, it's a natural like evolution of what you would do if you're forced to. So I think that's why Bitcoin, and it's the rational explanation for why Bitcoin makes a lot of sense.
And you mentioned earlier in the show that essentially what we're doing is just annihilating the middle class. And there's a great Charles Dickens quote that you shared with us that I think portrays this very well. Can you share that with us?
Yeah, it's a tale of two cities. It says it was the best of times, it was the worst of times. And so you really, if you're not invested in these like stores of value or productivity enhancing assets, you've largely fell behind. And that's, the middle and lower income It's
Mhm.
horrible, but that's why Bitcoin is so powerful. In this, there should be more of teaching and access for that, because
Mhm.
it's the norm throughout history for this to happen. Is It's kind of like Pareto's principle, like 20%, you end up centralizing all the assets and power over long periods of time, and you have to figure out kind of how to redistribute those. But San Francisco is a perfect example of this, where you have a billionaire class, and then the politics are so messed up that it kind of annihilates the middle class. And firefighters and policemen and teachers, they have to live like 2.5 hours outside the city because it's so friggin'
Mhm.
expensive. But if you're Mark Zuckerberg or Mark Benioff, you're
Mhm.
taking it. And so that's sort of what happens when you don't allow, the market to reset. And because the debts are so large, that's why the Congress and the Fed and the Treasury are all kind of in cahoots together, because they can't let it fall apart, or it would be, depression Armageddon. So the important thing to watch is watch treasury yields. If you have like a super spike in treasury yields from some global geopolitical event, and real rates of interest are rising, meaning inflation is falling and treasury yields are rising, you need to just get the hell out and stuff your money in cash. But
Mhm.
I think largely what you're going to see is there'll be negative real rates for our generation for the next 20 years as
Mhm.
we work our way out of these sovereign balance sheet problems.
Mhm. Mhm. And as an investor and
Mhm.
somebody listening to this show, obviously everybody listening to the show holds Bitcoin, so that's nothing new to anybody here, other than Bitcoin and perhaps gold as stores of value. And I know you've mentioned tech stocks as well, but what are the other assets that you would recommend as a way to protect against this situation that we're in?
I mean, those are probably the most interesting. I would say, another theme of ours is like nuclear. Uranium
Mm.
is a giant supply and demand imbalance. And
Mhm.
the one thing that governments are really scared of is, after the Russia invasion, and basically they had all control of that pipeline.
Mhm.
It freaked countries out. And now they're looking for a more decentralized energy base. So it's
Mhm.
not, and you're seeing, they just turned on 3 Mile Island again. They restarted another nuclear power plant in Michigan. So
Mhm.
they want a more decentralized energy supply, not just oil, natural gas. They want nuclear as well. And it just so happens no one dug up any uranium for the past frickin', I don't know, 15 years after the Fukushima disaster. So that's another way you could possibly play it in, the giant the supply and demand imbalances.
Mhm.
But there's lots of other things, like when you're talking about like frontier investing, the amount of space stocks, there's going to be giant infrastructure spend into space, and you're
Mm.
starting to see like that will be, I think, the next frontier. And the supply of space stocks is very thin relative to the amount of potential money going in there. So there are lots of different theoretical ways you could play it, but Bitcoin is the most fascinating to me
Mm.
because there's no supply response. There's always, when stock markets rise, there's always a Goldman Sachs or Morgan Stanley banker that's ready to sell you, more lithium or more uranium or more tech stocks and more bogus SPACs. But for the first time ever, you can't print more Bitcoin. And the convexity of the asset is just incredible. Meaning, like, it really, if you have a massive global money printing machine, which we're seeing right now, global M2 is rising.
Mhm.
If that finds its way into Bitcoin somehow as a reserve asset, it really is one of the most interesting things I've ever seen in my lifetime. And it's continuously gone for 15 years, and it's only getting stronger because the amount of dollars in the legacy TradFi system have just been pumped to oblivion.
Mhm.
And when the next generation takes over, God, it's really a mind blowing thought where it's less taboo to us. In fact, you could see, the next generation sell gold and go into Bitcoin as a store of value.
Mhm.
So lots of very interesting things happening right now.
Yeah. Yeah. Tyler, thank you so much for joining us today and walking us through your thoughts and laying this all out for us. Everybody listening in, I want to know if you guys are curious about learning more about uranium or about space exploration. That is not, those are two assets classes we have not talked at all about, but it's funny that you bring both of them up because I have been chatting offline with a few people. So let us know if you guys are interested in that and we'll bring a guest on. Tyler, really appreciate your time. Thanks so much for joining us. Would love to get you back on again at some point in the future. Maybe we do a Uranian episode with you, perhaps.
It sounds good. Whenever you guys need me, I appreciate it, Jay.
Awesome, my man. Have a great day. Thanks so much for listening in, everybody. Cheers. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only and nothing we say is financial advice. Investing in crypto or any asset is risky and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.